All right. Well, hello everyone. I'm Jonathan Harrison, partner here at Sound Stewardship. So, thank you for joining us for your 2026 Guide to the Markets. We're glad you're here. I'm really excited about our 2026 lineup of webinars we have planned for you. We have some great topics. For instance, our next one is February 26th. We're going to be discussing the book The Opposite of Spoiled: Raising Kids Who Are Grounded, Generous, and Smart About Money. So we'd love to have you join us for our next webinar on February 26th. But today we're especially thrilled to welcome a guest from J.P. Morgan Asset Management. Here at Sound Stewardship, we use JP Morgan's long-term capital market assumptions as a key pillar in all our financial planning models for clients. So we were delighted to line up today's guest from their team, Meera Pandit. As global market strategist, Meera conducts research on the global economy and capital markets. She frequently appears on Bloomberg, CNBC, Yahoo Finance, CNN. So we're thrilled to have her perspective with us today. So welcome, Meera, and thank you for joining us.
Thanks for having me. Excited to be here.
Quick note before we begin, I threw up a slide there, but everything we talk about today, it's informational, educational only, and reflects, where we are in January of 2026. But none of what we talk about or Meera talks about is personalized advice or specific investment recommendations. So we might use examples that are illustration only, but make sure you consult with your own investment advisor for your specific situation. Um, we're going to leave time at the end for questions. So as you watch, there's a Q&A button that's at the bottom of your screen. You can use that to submit answers for Meera, and we'll gather those and address those at the end. But I think that's everything. So Meera, the floor is yours.
Great. Thank you so much. I'm going to pull up a couple of slides here. These are from our Guide to the Markets, which is our flagship publication. And we really try to simplify the complex and look at things just in plain fact, objectively, to get a good sense of what's going on in the economy and markets. So today I'll talk a little bit about economic growth, jobs, the inflation environment, what our Federal Reserve will do to react to these various components of our economy, and most importantly, how we're thinking about different market dynamics and positioning within a portfolio. So let's start off here on economic growth. If we think about the year ahead, hot, cold, and K-shaped is how we see this year shaping up. So what this slide here shows is the contributors to real GDP growth. So how fast our economy grows on a typical basis is usually around 2%, but you can see in the recent quarters we had above trend growth for actually a nice string of time here, a couple years. Now, last year was a little bit murky because the first half of the year we had big swings in things like trade in purple and inventories in navy. But those don't actually tell you a lot about what's going on with the economy because they're not big drivers of the overall economy, even though they're pretty volatile categories, as you can see here. But really the backbone of our economy, which you can see in the table there, is consumption. It's about 68% of the overall size of our economy. So as we tend to say, as the consumer goes, so goes the rest of the economy. And what you can see in the third quarter here is that even if you strip out all of the other different categories, you can see here that the light blue portion here of overall consumption in the most recent quarter accounted for a huge portion of growth and also over 2% of growth. So if we usually grow at about 2% and we got just from consumption more than that, that's a pretty good sign for the overall economy. Now, if we think about how we ended the year, maybe just a little bit softer than that because we had the government shutdown that potentially impacted some degree of spending. But as we head into the rest of this year, we think it'll start off hot and then cool down and reassert its K-shape. So why might it start out hot? Well, first of all, consumers are expected to have above average amounts for their tax refunds. And about 60% of consumers or tax filers get a refund. And this year it could be up to $1,000 higher than it typically is. So what we know about the US consumer is a penny earned is a penny spent. So that may just go right back into the economy, driving up growth. Now, as we get into the part of next year, the second half of this year, Once that money is spent through, that's not a huge driver anymore of growth. And then you have things that have been weighing on growth, like some of the higher costs from tariffs weighing on consumers, or slower immigration resulting in less hiring and less available workers, potentially bring that growth number down a little bit. I also mentioned K-shaped because right now we have a so-called K-shaped economy. The upper part of the K is the upper income individuals driving a lot of that spending. The lower part of the K is this divergent outcome where middle and lower income consumers are just not able to spend as much because they're getting squeezed by those higher prices and a more challenging labor market. That may suspend itself for the first half of next year as the first half of this year, as everyone's doing a lot of spending, but in the back half of this year, we may start to see some of that weakness come back. Now, overall, again, with the consumer as the real backbone of our economy, it's not in bad shape. In fact, the aggregate consumer is in pretty good shape. What you can see on this slide here is the aggregate consumer balance sheet of about $200 trillion in assets, a lot of that home prices, a lot of that other financial assets, and then our aggregate liabilities. When people say, oh, the consumer is not doing that well, in recent years, we've seen a lot of home price appreciation. So in purple, that has helped the consumer balance sheet. And then you look at areas like financial assets, which have gone up massively since coming out of the pandemic. So right now you have about $10 in assets for every $1 in liabilities. Prior to the pandemic, it was more like $7 in assets for every $1 in liabilities. And then you look at the shape of liabilities, and a lot of it is mortgages. Now, a lot of people were able to lock in mortgages at low rates, and increasingly you're seeing home ownership shift, where it's many more of the older and more well-heeled home buyers. If you look at home buyers today, the average age is up to 40. So it's probably people who are a little bit more established in their careers, have a little bit more of a nest egg, and are able to buy a home. It is not general home ownership. So if you think about who even owns these mortgages, they probably have a reasonable ability to service them. You then look at the top right. I see all these charts that say consumer debt has never been higher. But in nominal terms, if you think about inflation, that's always going to be the case, probably. But it's really more about not the absolute level of debt, but how easy it is to service it. Can people make their debt payments? And what you can see here is debt payments as a share of disposable income. If you look at the most recent figure we have here, it's just about working its way back up to where it was prior to the pandemic. And in that time, it sort of flatlined for a long period of time after the financial crisis. So during the pandemic, people either paid off some of that debt or were able to refinance their debt. Their personal income also went up because of wage growth. So overall, the ability for people to service their debt is not much different than it's been over the last 15 or so years, still in a pretty decent place. And then finally, you look at that bottom chart on the right there, flows into early delinquencies. You see a lot of these charts as well when you see this spike in student loan delinquencies, higher auto and credit card loans. But if you look over the arc of history, you can see there that things were a lot worse on the auto and credit card loan side in the run-up to the financial crisis. You can also see that auto loans, student loans, and credit card loans together are just a smaller portion of the pie on the left-hand side than mortgages, for example, which still remain very much in a solid state. So again, this doesn't make a comment on how different areas of the population are doing. Certainly, again, that K-shaped economy, there are different outcomes for different wealth and income levels. But in aggregate, and we look at the consumer in aggregate because GDP is also an aggregate number. It doesn't care who specifically is spending, as long as there is aggregate spending, the aggregate consumer looks decent. Now, the challenge here that we could face is we may have some pretty decent growth this year, but it could be so-called jobless growth, where the economy is growing, but jobs are not making that much progress, and the labor market is sort of frozen. So what you can see on the left is non-farm payroll gains, that job creation on a monthly basis. And actually, when we had updated this at the end of the year, we had the most recent jobs print about 64,000 jobs. Last month, it was actually 50,000 in December, so it came down a little bit. And that 3-month moving average actually moved negative. So we've had a pretty weak jobs market over the past 6 or so months. And I would typically say that a chart that looks like this on the left might mean recession if you look at it in isolation. But we don't foresee a recession in our forecast. And part of it is not only is there not a lot of job creation going on, but there's also not a lot of job supply. So when low demand meets low supply, you can actually sort of exist in this tenuous equilibrium where the overall unemployment rate remains low. So what you can see on the right-hand chart there in gray is the unemployment rate. Actually, as of December, this ticked down to 4.4%. So again, things are looking in okay shape. And we care so much about the labor market because the worker is the consumer is the worker. So broadly, people have jobs, and broadly, when they do, they're able to support a basic level of consumption. You can also see wage growth in blue. That's actually come down to about 3.6%, but it is still outpacing inflation, which means overall wages are increasing faster than the cost of living is. So that again is a checkbox in the support of the overall consumption environment where the labor market admittedly is weak, but it is existing in this interesting equilibrium where there's not a lot of supply of workers because we've seen some pretty massive immigration changes, and a lot of our incremental growth in workers does come from foreign-born workers. And we also don't have that much demand for workers either. You do still see people getting hired, but it's often are these people driving the top line growth? That's why you tend to see that youth unemployment is a little bit more challenged. Maybe some of it is AI or the anticipation of AI, but I think really people are looking for those who can have some experience to drive some results to profits. Now, the other big prong of the overall economy is around inflation. And the expectation this year is for inflation to lift, and then downshift. So this chart here looks at overall contributors to inflation. And you can see here that at 2.7%, things have gotten a lot better than certainly they were a few years ago, but they've been drifting higher since April overall. So if you look at where we are today, we've already started to see evidence of the first lift. That first lift is from some of these pass-through impacts of tariffs. So you can see in purple, food, in orange, core goods, those are categories that have increased. They're certainly not surging like they did in 2021, 2022, when we had supply chain issues and commodity price spikes, but they are increasing on the margins, and that is putting some upward pressure on inflation. Now, as Chair Powell says, inflation is likely to be a one-time impact on inflation, but may not happen all at once. So we may continue to see these tariff impacts play out for the first half of next year. Or excuse me, I keep saying next year because I keep thinking it's December. The first half of this year. The other lift we may get relates back to those tax refunds. If people are consuming more, growth and inflation often move in the same direction. So if you have higher growth because people are buying more, that demand also potentially fuels higher prices. So you may get that other lift from these tax refunds and people doing a little bit more spending. But again, one-time impacts from tariffs, people spend through their tax refunds, and then in the back half of the year, inflation starts to slow again. So we think inflation could peak in the midpoint of this year, somewhere around 3.5%, but then come back to closer to that 2% rate. Just take a little bit of time. Now, if you put all of this together, it's quite a challenge for the Federal Reserve, our central bank, because they have to weigh two things that they pay attention to the most closely. They want price stability, and clearly inflation is still a little sticky. And they also want maximum employment, and clearly the labor market is a little bit weak. So underneath the surface, you have half of the committee looking for some greater price stability and therefore wanting to keep rates where they are, and the other half of the committee worried about the jobs market and wanting to do more meaningful cuts. The reality is, though, if you take a giant step back and you look at where the Fed is thinking they're going to go, the Fed has said maybe we cut once this year in aggregate. Now, maybe some people think that we should cut more, some people think we should cut less, but the general consensus there is one cut. The market thinks probably closer to two, maybe not so far from 1.5. So the difference is here, even though there's a lot of headlines about Fed independence and the cutting cycle and where rates go, we're talking on the margins here, one or two cuts left at most in 2026, barring any major calamity that potentially portends a recession, which is, again, not our base case here. So you're looking at a little bit of changes on the margin, cuts likely few and far between in 2026 to wrap up that Fed cutting cycle. Now, that creates an interesting dynamic here. If you own shorter term bonds, those rates are coming down as the Fed cuts. So it means if you get 3% yield in 6 months' time, you may be getting slightly less than that. So there's some reinvestment risk at the short end of the curve. If you think about longer term bonds, bonds tend to do poorly when rates rise because your capital depreciates there. And yet there's some upward pressure on yield at the longer end of the curve. So it doesn't feel like it's actually that good of an environment overall for the bond market. But then you look at the table on the left where we look at returns in 2025, and you had every single area of the bond market, whether you were short term, long term, or different sectors within the bond market, in the black. In fact, you had equity-like returns in so many different parts of the market. And what it reminds me of is, it's basically one of the best years for the bond market since 2020. And yet it reminds me of what is anchoring returns right now. Because we existed in a paradigm from the financial crisis to the pandemic where you couldn't find income in fixed income. But rates sometimes fell, even from a relatively low perch, pretty far, and that gave you a pretty nice return. Now, you may not get a lot of benefit from rates falling. Rates may not fall that much, but you are getting income because they have reset to a higher level. So that coupon you're clipping is finally pretty attractive again. So what we did here on the right-hand side is we set up a little bit of a hypothetical here. What if you happen to see a 1% rise, a 1% fall, or no change at all in rates? How would that impact your bond allocation? Because again, you think about reinvestment risk, you think about duration risk, it doesn't feel like it would be that great of a time, but you can see that the risks are not symmetrical on either side here. So if you look at the aggregate category, sort of halfway down the slide, that US aggregate, you can see that if we were to have a 1% rise in rates, so we're about 4.25 today on the 10-year, let's say we were above 5% on the 10-year treasury yield, we would be down about 1.7%. Not great, but certainly not the experience you would have had in 2022 when you had double-digit downdraft in bond returns. That's because the starting point is high, so a 1% rise is not going to make such a difference. And also, you have that income to offset some of that capital depreciation. On the flip side, if you were to see a 1% fall in rates, you're looking at an over 10% return because you not only have that capital appreciation, but you also have that income component. So you pair both of those together, and what you're left with is the fact that income is providing both yield and protection. Now, the reality is we don't expect to see a 1% move. In fact, the volatility in the bond market that was so persistent for the first 4 or so years of the decade has died down a lot. And that is a good thing. Now, with greater stability here, we actually don't see a whole lot of change in that 10-year treasury yield. Let's say we're somewhere between 4 and 4.5%. It's actually exactly where we are today, but we don't see too much movement within that range. If you see no change at all, you're still clipping that coupon and therefore getting about 4.3%. And that's just an ag bonds, just a broad measure of different areas of the bond market. If you then are a little bit active and you get into some of the areas that we like the most, whether it's securitized, different areas of the credit market, some global bond areas, or municipals, then you're able to achieve an even more compelling return. So all of that is to say, it's not all doom and gloom in the bond market. In fact, that was one of the big upside surprises we saw in 2025. Now we think about the equity market. And if we think about predictors of future returns, often people look at valuations in the long run, how cheap or expensive stocks are, to give a good prediction of returns. So if you can see on the left-hand chart, the forward PE returns and the 1 year later what the returns ended up being, it's a little bit all over the place. It doesn't give you a great test or great predictive power of returns today are 22x, so therefore in 1 year returns will be Y. However, as you extend out that time frame, the predictive power of valuations becomes stronger. And you can see here that if you have a 22 times forward earnings multiple, which is just a hair lower than we are today, you're basically pretty close to zero in your implied forward-looking returns. So it is important to recognize that we've had such strong returns in the equity market. Some of them may be somewhat borrowed. from future years. Now, the flip side to this is this chart has kind of looked like this for years now because valuations have been high for a long time. They've stayed high, and yet you've seen the progress we've had in the equity market with the amazing returns that we have experienced. We're seeing strong profit growth. We are seeing innovation, and that has resulted in 3 consecutive years of double-digit equity market returns. So I definitely take this as a setting expectations slide in that we've gotten such a good run that we should be a little bit realistic about what we can achieve from here on out. But the counterpoint to that is we've seen some upside surprises in the past, so I don't think we should be too pessimistic about returns either. They just might come from different places. Because one of the big distortions in the market and why valuations are so high is because markets have become so concentrated in a small number of stocks that have done really, really well. From a profits perspective, from a performance perspective, their valuations are expensive, but they're certainly not extreme. So what you can see on the left-hand side of the page here is we look at the top 10 companies in the S&P 500. A lot of those are your so-called Magnificent Seven stocks with a couple of others. And you can see here that those top 10 stocks compared to the top 10 stocks at any other point in history back over the last 30 years are about 36% more expensive than their long-term averages at 28 times forward earnings. So no doubt these stocks are expensive, but they are not extreme in terms of their valuations. If you looked at just the tech stocks during the internet bubble, they were closer to 70 times forward earnings. So at 28 for the aggregate group of the biggest stocks in the market, that's, again, expensive, but not extreme. And the rest of the companies within the market are still about 21% more expensive than their long-term averages. The reason why I show you this is because there are some interesting dynamics at play in terms of elevated valuations and market concentration that we should be mindful of. I think about this as a risk, but not a fear. The risk is that left-hand side, where when valuations are priced to perfection, they are prone to correction. So expect some degree of volatility and some meaningful pullback at some point in the year. Now, if you look at the right, this is why it's not a fear for me, though. We have seen a record level of concentration in the S&P 500, with those top 10 stocks making up 40% of market cap. So if you think about any sort of correction in a concentrated part of the market, you're going to feel that a lot more in your portfolio if those stocks correct, because there's such a large share of portfolios. So it actually makes them a little bit more inherently volatile, your returns. But what I will also say is, even though about 40% of the index is just 10 stocks, they are also producing about 33% of the overall earnings. I'd love to see those lines move in lockstep. They're not quite there, but they're pretty close together, which means those companies are pulling their weight in the index since they are earning nearly commensurate with their overall weight. But nonetheless, the valuation and concentration risk is certainly something to note, because while we might not see this huge crash in the markets, over time, history has shown us that the leaders of today may not be the leaders of tomorrow. So what this slide here shows is the top 10 companies within the S&P 500 back in 1985, 1995, so on and so forth. And we've colored all of the companies from 1985 green. So if any of those companies persist in another set of decades, we keep it in green. But then anything new in 1995 is gray, anything new in 2005 is light blue, and again, so on and so forth. So you get a good picture of how this leadership has changed over time. Who are the new players? Who are the old players? And while the market concentration, the leadership today feels very inevitable and very invincible, history has shown that some of these companies may go bankrupt at some point. Some of them may not. I mean, a lot of the ones on this page are pretty strong, but they may fade it back into what I like to call the kind of blue chip graveyard. They're still very strong, healthy companies. You want them in a portfolio, but they're not going to be your high octane growth opportunities. Said another way, the biggest may not always be the best when it comes to performance. And that is something that we are already seeing playing out today. So what we can see on the top left chart is we look at the Magnificent Seven those big high octane tech names, huge cash balance sheets, lots of innovation, lots of spending relative to everything else in the S&P 500 in blue. And you can see that back in 2023, they made up for 63% of all the index's returns. In 2024, that came down slightly to 55. In 2025, that came down to 46. So we're seeing that concentration and that grip these stocks have on the markets gradually dissipate. And in fact, this year, those stocks are down while the rest of the market is up. I think a piece of that is, look, a lot of things are priced in. A lot of things have gone the right way for the Mag 7 in recent years. Things are rotating into everything else as they catch up. Now, if you look at the bottom chart there, you look at year-over-year earnings growth in green relative to the S&P 500's other companies in blue. And the Mag 7's profits have decelerated, although are plateauing at a very healthy 20+% growth rate. That is great news. But the rest of the index is actually earnestly starting to pick up. In 2023, things were supposed to broaden out, didn't happen. 2024, same thing, didn't happen. But in 2025, to have 9% potential growth in every other stock in the index in aggregate is a really strong number. So you are seeing the rest of the index pull its weight in terms of earnings. Now, I wouldn't say this is strictly all of the 493 in a diversified way. I would say that a lot of this does have to do with other AI companies. Other things in the AI ecosystem related to tech, things related to the infrastructure, whether it's industrials, materials, utility, providing that power generation. And you do see it outside of the AI realm in areas like financials as well. So there's other things going on here. A lot of it, but not all of it, is related to AI, which is something important to note, that this theme itself is evolving, and perhaps the Mag 7 is increasingly becoming a bit of a fading concept. Now you can see that again in terms of performance last year. You take a look at the right-hand chart, and in 2023, every single stock outperformed the index. In 2024, all 6 of those Mag 7 stocks outperformed the index. But last year, just 2 of those stocks outperformed the index, and the magnitude of that outperformance has really shrunk over the years, really encouraging us to not only be active in terms of what we own within the Mag 7, but certainly outside of it. Again, these different players within the AI ecosystem. Other tech, industrials, utilities, and areas outside of that in areas like financials. And by the way, a lot of those sectors that I just mentioned also experienced double-digit earnings growth last year. That's what's driving up that blue number, that 9% for 2025. Many of those other areas also had really strong earnings growth, and ultimately that's what you want to underpin your returns. Now, maybe taking a bigger step back and thinking about the markets and the fact that we continue to reach these new all-time highs. Great for the past. We feel good about the returns we had, but how do we feel going forward about the returns we might get? Again, it kind of relates back to that valuations chart where the future doesn't look as bright as the past. But there is some nuance to this around all-time highs, because I think mentally we think all-time high is synonymous with market top, and that hasn't been the case in history. So if you look at the chart on the left, we look at the S&P 500 over time, along with the times in green that the all-time high was not the market top, but actually the market floor. And that was about 30% of the time. So you have many instances where we get to this new all-time high and we never retrace that value. And over the longer term, the S&P 500 has never failed to regain a prior peak and then surpass it. So it is something that we tend to see quite often. The other dynamic I'd point out about all-time highs is that momentum begets momentum. They tend to cluster together pretty tightly. It's something like 80% of all-time highs occur within a few weeks of each other. Now, if you look at 2024, we had 57 new all-time highs. Last year, we had 39 new all-time highs. So imagine getting in at all-time high number 4 in 2024 and riding your way up to all-time high number 90 last year. You essentially are compounding that benefit all the way up. And that's what results in the dynamic on the right, where you can see that investing on any day may not be as fruitful as investing at a new all-time high because of that momentum dynamic. Whereas investing on any day could mean that you're investing in a bear market, or you're simply investing in a sideways market that's not doing a whole lot to compound over time. Now, despite a tumultuous start to the year, diversification was up about 16% in 2025. Keep getting my years confused here. Last year, it was up about 16%, which means it was also the 3rd year in a row where we had diversified portfolio in the double digits. Now, if I look at this chart here, it's a top to bottom ranking of basically a scorecard of different asset classes over time. And you can see in 23, 24, 25, somewhat unexpected and varying results across each year where different things are leading, different things are lagging. I think 2025 was surprising in many ways because international stocks outperformed for the first time in basically 8 years. You had bonds have equity like returns in many different areas. And while you had a very strong year for cash yet again, and in fact, this last cluster of cash returns over the last 3 years was one of the strongest in almost 25 years, it didn't beat that diversification. And think about it. This year we had DeepSeek. Last year we had DeepSeek. We had the government shutdown. We had tariffs. We had a war. And yet still you had double digit returns in that diversified portfolio and doubled, tripled, or quadrupled that cash return in any given year. And that's really the secret sauce here, where you're capturing returns on the upside, but protecting on the downside when you diversify. Now, it's not just being diversified, but it's also staying diversified. Because you may decide, okay, the appropriate allocation for me is a balanced 60-40 portfolio, 60% equities, 40% bonds. That's what I'm going to do. That really meets my needs in terms of how I want to grow my assets, but also how I want to protect. And yet, if you just set it and forget it, markets move, things drift. If you had your 60-40 portfolio right before the pandemic, at the end of last year, you were actually closer to a 70-30 portfolio. Not exactly what you were looking for to start. That's why rebalancing and making sure we're tweaking that allocation at the right points in time can help us to make sure that we're aligned with what we thought we owned. Now, finally, this slide kind of brings together some of those different concepts: diversification, longer term time horizon, that portfolio hygiene. And as we start the new year, I've been thinking about resolutions, and a lot of times people set out these health resolutions. I want to get healthier, and therefore, people are looking for the silver bullet. What's going to just flip the switch and make me a healthy person? Well, it's actually pretty easy if you think about it, or pretty simple, I should say. You want to eat well, sleep, hydrate, exercise, simple solutions, but actually not that easy because you have to be pretty disciplined to do all of those things all the time. And a portfolio is actually pretty similar, where the solutions are simple. You diversify, you rebalance, you have this longer term time horizon. But they're by no means easy because they do require a lot of discipline. But investing, like health, there is no silver bullet. There is no magical asset class that's always going to be at the top of that chart I just showed. So we have to practice that good portfolio hygiene. Now, what this chart shows is a range of stock in green, bond in blue, and 50-50, 60-40 portfolio returns in gray. Now, just to give you an example, this goes all the way back to 1950. So if you were in 100% all stock portfolio for any 1 year, from 1950 to last year, you could have been up 52%, but you also could have been down 37%. Huge range of outcomes. You don't want to be an investor for just 1 year. But when you extend that time horizon out 5, 10, 20 years, you can see that range of outcomes compresses and overwhelmingly skews positive. And in particular, you can see that 60-40 portfolio tends to not have any negative rolling periods over a 5, 10, or 20-year basis over the last 75 years, effectively. So that is your proof statement for why we do practice this portfolio hygiene and why we do make sure that at this time of year, we really want to look things over and feel comfortable about what we have going on for the rest of the year, given the backdrop that we potentially expect for 2026. So maybe with that, I will pause there and happy to open it up and answer any questions.
Yeah, thank you so much. That is, there's a lot there and really appreciate it, but so interesting to me, particularly like slides 11 were really encouraging, talking about the really strong earnings behind that growth. And then slide 12, that was fascinating that almost a third of all-time highs are the floor of the market. So when I hear people say, well, I'm going to wait until, there's some big market drop before I get in, because the market's hitting all-time highs almost a third of the time, it never gets back to the spot where it crosses that new all-time high. So that was awesome. Okay, so I have quite a few questions. One
Yes.
thing before we start is some people have asked for the slides, and I
Yes.
know your website has the full guide with all 130 some slides, and these are just some selections that you've pulled out of that guide to the markets. Do you prefer us to send the full guide or send a PDF of these specific slides?
Either. I mean, you could also send both. It's all
Okay,
publicly available, so whatever you prefer.
great. Okay, well, we'll make sure those who are asking for those get that. But okay, question. Maybe if you go to I think I heard you refer to it as that jelly bean slide. So one of the things that for last year that was really interesting, it's not on here specifically, but in some of our portfolios, some clients hold precious metals and typically thought of as like a safe haven asset. They did phenomenally well last year, but also in a year where equity was doing everything was up pretty well, especially equity. So any thoughts as to why the safe haven assets would be doing great in a year that the equities themselves are doing great?
Yeah, it's such an interesting dynamic because usually when there's fear in the markets, people are selling equities. Instead, people were buying equities and also buying metals. So it's not something that you usually typically see. And also, fixed income did pretty well because of the income component. But also, we saw yields drift a little bit lower throughout the year. So it was sort of an everything rally in many different parts of the market and responding to different things. I think the equity market resilience was still very much around this AI story that whoa, this is a big deal. This is innovation. This is very different than your run of the mill market, run of the mill technology changes. This is something that is like generationally different. So I think that people still were very interested in buying into the equity market because of that AI story, and particularly underpinned by profits. So you look at this slide here and you see 23, 24, 25, the large cap category in lighter green. You had extraordinary returns in each of those years. But in 2023, about 73% of your return was just from multiples moving higher.
Hmm.
Last year, 84% of your return was actually from earnings growth. You didn't see multiples move all that much. So, in a way, we've had a higher and higher quality rally because people are getting what they're paying for. That earnings growth, it's those type of fundamentals you want to see underpinning your equity market allocation. Now, on the metal side, look, it doesn't take away from the fact that, again, we had a war, we had a government shutdown, we had tariffs on again, off again. Here, they're on this, they're on that. There's still uncertainty around the exact legal, outline and structure for what tariffs will look like. And of course, news about Greenland coming out over the weekend, Venezuela 2 weekends ago. There's so much going on the geopolitical front. There's a lot of uncertainty. And I think that people are really leaning into the metals story because of that. Now, that's a piece of it, this growing fragmentation and people wanting hedges. I think also the fact that we are somewhat inflation prone as an economy has also been a little bit of an inflation play. And then finally, if we think about things like AI, I mentioned things broadened out from just tech to other parts of tech, industrials, utilities. Like AI and technology has gone from a very capital light business model to a very capital intensive business model. And think about the inputs that you need to make AI work, things like copper, for example. So it's no surprise to see a lot of different commodities really rallying last year because if they are inputs in this AI infrastructure, there's going to be massive demand for them. And therefore, I think you saw a lot of certain metals, maybe gold plays less into that because it's not really have an industrial usage, but other ones that really had a good showing last year because of partially the industrial usage there as well. So it's the politics aspect, it's the inflation aspect, and it's the potential AI demands from a commodity perspective, all sort of converging on each other.
Hmm. Well, and somewhat related to that, your first slides showed really pretty strong economy. Really like we talked about the strong earnings growth related to the upswing of the market, but at the same time, there's really negative consumer sentiment. And so,
Mm-hmm.
similar to the precious metals discussion, how do you pair, or what's the reason behind? Like on the one hand, when we look at the numbers for clients, we're like, hey, you're in a great situation. But when you hear the client talk, whether it's about inflation or just about how they feel the economy is doing, there seems to be a disconnect. So, do you see any reasons behind the scenes why there might be such a strong disconnect?
Yes, I'm actually going to pull up one more slide here that we have in our broader guide to the market. So if you get that full pack there, you'll find it here. that looks at consumer sentiment in the stock market. The first thing I will say is that consumer sentiment is not that great of a predictor of actual consumption. So people look at sentiment, it's so bad, and they're like, oh my God, no one's going to spend. That is very much a dynamic in places like Europe or China. People feel bad, they don't spend. In the US, it is retail therapy all the time, where you feel bad, you spend. You feel good, you spend. So the sentiment numbers don't actually tell us a lot about the consumption patterns and therefore GDP patterns. But sometimes they are a good contrarian indicator of the actual stock market. What you can see on this slide here is we look at the peaks and the bottoms in sentiment over time. And during the peaks in sentiment, if you invest in the stock market at a sentiment peak, about a year later, you'd be up about 4%. So not bad, but there's not a lot of runway left when everyone's feeling amazing. But then if you look at the bottoms in sentiment, when people feel absolutely down in the dumps, 1 year later, you have seen about a 25% almost return in the markets there. So it tends to be a contrarian indicator when we think about the stock market. It doesn't tend to tell you a lot about consumption patterns. I think what's going on right now is, look, markets have been good. Oil prices have been relatively low, so when people are filling up their cars with gas, it's not overly expensive. But the overall inflation environment, while inflation has come down, price levels haven't, and they aren't going to. And I think to see very little price increase for basically 12 years and then see rapid changes in prices really driven up over a very short period of time is dissonant and challenging for the average consumer. And not everybody saw their wages go up either. So I think the general affordability, but also the housing affordability, the average age of a homeowner, I think I had mentioned earlier on that slide, is of a first-time homeowner is 40. So you're
Mm.
not a young person that's able to buy a house right off the bat. It's going to take you some while. So the American dream that was promised to many slips further away from them, and that doesn't feel great. I also think because we are able to see how the richest of the rich live on Instagram, whereas you used to really just see the people in your neighborhood, maybe who lived in the nice big house on the corner. I think that that also creates a lot of discontent because people think like I should be living that kind of life and I don't. So I think that there's a big social media
Mm.
component to that. And also, of course, a political component to that where once upon a time you could be a Democrat or a Republican and like maybe you didn't really agree with the other side, but overall everybody really rallied around the country and there was like a lot of patriotism. Now it's like you're only patriotic if your guy's in the White House. And even if they are, like half of you are probably actually not even feeling that good about things. So there's just generally more pessimism in the environment that we're in.
Mm. Hmm. Yeah, that's interesting. Well, and around that first-time home buyer concept, we had a question, if interest rates don't look like they're going to change a whole lot this year, what about mortgage rates? Because commonly, I hear somebody who says, "Hey, oh, I just heard interest, dropped, and so I'm going to run and, I'm going to start looking at buying a home again." And then they talk to their bank, and well, actually, mortgage rates have gone up a little. So, any information or stats you have around what mortgage rates might do if interest stays where it is now?
Unfortunately, I'm not sure that mortgages our mortgage rates are going to come down all that much, especially as we conclude the Fed cycle here. Now, maybe the good news is historically, if you look over the longer arc of time, they're not that high. But if you look at the recent past, gone are the days where people are going to be getting 2 or 3% mortgages. That
Mhm.
is unfortunately the sad truth there. So maybe they'll come down a little bit over time, but the problem is this supply demand dynamic where the Fed was buying up mortgage-backed securities, bringing mortgage rates down, and they're not doing that anymore. And their balance sheet is normalizing. The supply out there then just creates a bit of a lopsided dynamic there. And so these rates are just not likely to come down all that much. And again, I think gone are the days of 2, 3% mortgages. I think it'll take us some time to get even to 4%. So that there are some challenges there when we think about the mortgage market and how much room there is for those rates to come down.
Yeah, I can't tell you how many people I've talked to who want to move, but because their mortgage is two something percent, they won't let it go. And unless there's they have to move across the country or have to move. they won't do it. And I think that's it's some distorting the housing market some because
Yeah,
there's
people are
just
kind of
not.
locked in a little
Yeah.
bit. At least it does seem like home prices are softening a little bit. We had this chronic undersupply problem for a while, but now actually supply is looking reasonable. So there's greater supply out there. There's some more completions in home builds. So it's less about the home pricing as it was during the pandemic where everything really skyrocketed, and more about the mortgage piece of that. So at least there's a little bit of relief on at least the home pricing side.
Relief depending on who you are. I also, for the first time since the Great Recession, have some clients who are underwater
Mm,
again because where they bought in versus where their mortgage is now didn't experience the growth that before the pandemic or maybe even during the pandemic really
mm.
experienced. But maybe the last question is when you think about those all-time highs and investing into the stock market. Do you have any, I don't know, I don't remember seeing this in the guide deck, but any slides or statistics around, let's say somebody receives, an inheritance and they're thinking about, oh, do I invest $1 million today, which might be an all-time high, maybe not literally today, but right now, or doing the dollar cost averaging strategy around 12 or 24 months. Any statistics or thoughts on which method tends to win over the long term?
So it's a little bit tricky because if you're dollar cost averaging into an up market or a down market, you're going to have some different results there. But we're often going into an up market. I mean, if you look over the longer period of time and you look at calendar years, for example, 75% of the time we are higher to end the year than we were than we started. So in that sense, when we think about market momentum and generally speaking, the direction of the stock market, it tends to make sense to just put your money in when you have it as opposed to phasing it in. Now, I will say, like, some people just psychologically have trouble doing that. And I think as long as you're getting invested in a reasonable amount of time, if psychologically if it makes you feel more comfortable to dollar cost average in, then you do whatever you need to do to get in. But typically, just because of the nature of the markets, and again, you think about that momentum and the all-time highs, um, it often does make sense to just put it in right away and get it to work for you.
Yeah, there's a big psychological element that, of course, it's easier to choose wrong if you, and I sometimes ask questions, which would you be, or ask clients, what would you be more ticked off with if we plugged it all in today and, turns out the market's down 15% 12 months from now, or if we plugged it in slowly over the next 12 months and it turns out, the next 3 months is when all that growth really happened and that helps really sometimes remind people that it's really investing is a long-term exercise. And back to your slide around the longer you're invested, the less those, 12-month returns matter. And it's more about the long-term investment hygiene, like you said. So I think that is it for today. Thank you so much. Really appreciate you joining us from New York.
My
And
pleasure.
we'll send out the slides, we'll send out recording for those who aren't able to join us today and some additional resources. And then yeah, we hope you can join us for our next webinar on February 26th about raising kids who are generous and not spoiled. So thank you, Meera. Hope you have a good rest of your week, everyone.
Thank you.
Bye.